All right, so as Renee said, my name is John Kmiecik, and I really enjoy teaching options education, and at heart, I still trade every single day, and I run a trading room every single day as well. So basically what we're going to go over today is actually one of my favorite kind of trading styles is high probability trading. And just the name of it sounds enticing, right? Everybody likes to put the odds on their side as traders. It doesn't matter what you're trading, but certainly as traders, whatever you're trading, currencies, options, equities, you certainly want to put the odds on your side as much as you possibly can. So before I get started, let me point out the obvious and sometimes obvious that trading and options, as I like to say, life in general involves risk, is not suitable for all traders, investors, or human beings. Prior to buying or selling an option, a person must receive a copy of characteristics and risks of standardized options. Copies are available from your broker or by calling 888 options, which is indeed the Options Clearing Corp, located right here where I'm located in Chicago, Illinois. All right, so let's talk about high probability trades. Now, there's certainly, as some would deem, probably quote unquote high probability trades, but I'm going to talk in particular, or about one in particular here. As I kind of mentioned already, as traders, we obviously want to put the odds on our side as much as we can here. Vegas uses odds, right? The house is always going to win over the course of time here. But as professional traders and quant traders here, we use statistics to try to put the odds on your side. And a lot of that is based on options and the options pricing models that we'll go through here as well, trying to put the odds on your side as a trader here. So we're going to talk about high probability trade and income trades. Now, there's more than a few income trades, but income trades just by their nature are high probability trades. And income trades are trades that generally profit over time. And that's why they're kind of called income trades. Time helps, doesn't mean you're going to profit, but they can profit over time. Generally, they can be measured with predictive results. Now, certainly doesn't mean you're always going to make money on them, but certainly putting the odds on your side is a good place to start. So a couple income trades that are out there are calendar spreads, like time spreads, diagonals, but we're going to talk about here in particular are credit spreads, and specifically out of the money credit spreads. So let's break down, how many have you traded options out there? Do we have some people that have traded options, or are options relatively new to you out there? You've traded options, great, great. So this will be a little review here, and certainly if you're brand new to option trading, it might be a little bit overwhelming here, so I'll try to go a little bit slow on this, but I'm assuming at least a few of you guys are at least familiar with options here. Now, if you've ever bought an option, which I think probably most of us have when you first learned about options, buy call options. You know, we're immediately attracted to options because of the cost. Well, I could buy shares of stock of Apple for $118, or I can buy a call option at $118 a share, or I can buy a call option that could maybe do approximately the same thing for about $1,000. So to me, that was kind of the biggest draw 20 plus years ago when I first learned about options. The first option of Chicago and then Goldman Sachs later on was, wow, you really can, you know, get a lot of bang for your buck using options. Now, certainly it's not a perfect trade-off here. Now, certainly if you've ever bought an option, which I'm assuming if you've ever bought an option, this has probably happened to you as well, is you've seen it deteriorate or lose value over time when the underlying has not cooperated like you've expected to. So if you buy a long call, generally a bullish position, the call option can increase value if the underlying moves higher, but sometimes, as always, it doesn't mean it necessarily moves higher. Sometimes it trades sideways, but options are decaying assets and they lose value over time. So I think after you've gone through that a few times, you're like, you know what? I kind of want to be on the other side of that equation for once. Instead of buying options, hey, it makes sense to sell options instead. So when we talk about selling options here, our goal is just the opposite. Of course, when we buy, we want to sell for more, but when we sell, we want to buy back for less or not at all, have the option expire worthless. So your general goal when you're selling options is, of course, buy the option back for less later. And I'm not going to go into a big trade management plan, but generally I put a target out there, generally a buy limit to buy back at a certain level. It doesn't mean I'm always going to hit that target level, but I always put it out there. And as I mentioned already, options are decaying asset, right? They lose value over time, so it could profit from time decay. The premium is becoming less and less, at least based on the time component alone. It certainly could be losing money from other moving parts with the options, but time is always going to decay the asset. So time decay. In other words, theta, as we talk about in the Greeks with option trading. Now, the risk you have with selling options is from the direction, just like you would have in buying options, right? You buy a call option, you want the underlying to move higher. Well, same principle applies here. You sell an option, you're still subject to risk on the direction of where the underlying is moving here. So, no, I do not, Kathy, but just your comment cracked me up. And volatility, which again, if you're new to option trading, we're going to talk just a little bit about it, but volatility is how options are priced. And if you know anything about options, currently the implied volatility of many options are essentially trading at their 52-week low. Now, certainly over the last couple of days, the market has moved lower. As a general rule of thumb, when the market moves lower, that fear factor comes in the market and implied volatility increases. In other words, option premium increases. And of course, just before these last couple of days, the market obviously been trading at or close to its all-time highs. So the implied volatility, in other words, the option premiums have been relatively cheap. So certainly, if you're selling premium, you prefer the implied volatility to drop. It doesn't mean it's always going to happen that way. And of course, if you're buying options, just the opposite, you prefer the implied volatility to increase. When you buy something, you want the premium to increase. And of course, if we buy an option, we're limited on our risk, right? The most we could ever lose on the trade is what we paid. Now, it could be substantial, right? We could have bought some expensive option. It could be substantial. But when we're selling options, we don't have the right, right? We don't have the right. You know, we have the right to do something when we buy an option, but when we're selling option, it's not a right, right? It's something that the stock. Let's use a put option, or well, let's do call options. We've been talking about call options. So if you buy a call option, you have the right to buy the stock at a certain level, right? As I said, if the stock never moves higher or even drops on you, the most you can ever lose. Well, the seller of that option, well, he has risk there because the owner, the buyer of the option, always has the right to do something, right? Always has the right to do something, but the seller has an obligation. So if the underlying moved against them, the losses could be unlimited, theoretically, right? The stock can obviously go up forever. It won't go up forever, but it could be unlimited. So that's where it gets a little bit tricky with selling options because your risk could be either down to zero or theoretically unlimited to the upside then. Unlimited to the upside. Yeah, the obligation. Thanks, Bob. So solution, as I like to trade in general, not just credit spreads that we're talking about here today, are spreads in general. And that could be a credit spread. So a call credit spread involves selling a call option, but buying a higher strike call with the same expiration on the same underlying. So selling a call, let's say we sell a 90 call and buying a 100 strike call above it. So short the 90 call, long the 100 call. And a put credit spread, we kind of be just about the opposite here. You're selling a put and buying a lower strike put as your protection, just like you bought the higher strike call to protect yourself in case the underlying moved high and against you. Well, here you're selling a put and you're buying a lower strike put in case the underlying drops a considerable amount, same principle here, with the same expiration on the same underlying here as well. So call credit spread, we're selling a call, buying a higher strike call. A put credit spread, we're selling a put, and for protection, buying a lower strike put. Now, a call credit spread at expiration, the maximum profit occurs if the stock is at or below the short strike, right? If it's at or below the short strike, both call options expire worthless. So using our 90, selling our 90 call, buying our 100, as long as the stock, the underlying stays at 90 or below, those call options will expire worthless. So the maximum loss occurs if the stock is at or above the long strike at expiration. So in our 90-100 example, it would be at 100 or higher would be our max loss. And the break even is calculated by adding the credit from the trade to the short strike. So let's say we brought in a credit of $2 on this trade, sold the 90 call, bought the 100, and we'll go through a couple examples here. Actually, a couple I talked about today. I brought these in as well. So say we sold the 90 call, bought the 100, brought in a $2 credit. Well, our break even would be 90 plus that $2 credit we received, or $92 at expiration. Now, put credit spread, again, just flip everything around here. At expiration, the maximum profit occurs if the puts expire worthless. So if the stock is at or above the short strike at expiration. So let's say we sold a 50 put and bought a lower strike put for protection at $45. Both puts would expire worthless at $50 or higher at expiration. And of course, maximum loss occurs if the stock is at or below the long strike. So at $45 or less, no matter how much it drops, your max loss is always going to be the same. Now, if you just sold that put on its own, well, the stock could continue to drop, and you're on the line, right? Because someone has the right to sell it at $50, and the stock actually is trading at $20. Well, to have $30 intrinsic value in there, and you'd be forced to either buy it back or have the stock put to you at that price then. So certainly using a spread trade can limit your loss on the trade versus naked options that we just talked about here. Now, the break even for a put credit spread, or a bull put spread as it's called, is calculated by subtracting the credit received from the short strike. So let's say you brought in 50 cents, you sold the 50 put, bought the 45, you brought in a 50-cent credit. Well, your break even on the trade would be $49.50 at expiration. So, all right. So P&L diagrams, profit and loss diagrams. Essentially, I'm sure you've seen them before. The horizontal axis tells you where the stock price is, and the up and down. The vertical axis tells you max profit and max loss, and in between with the stock, and of course in this case the options at expiration. So as I always say, you know, most, if not all, platforms draw P&L diagrams for you. A long time ago, it wasn't necessarily the case, but over time, most brokers, platforms have got more advanced. So I always like to tell traders, you know what, you don't have to know them backwards and forwards, but certainly what I use them for more or less is catching myself on a mistake, whether it's entry on a trade I'm putting in. So when I'm setting up a trade, not even just a credit spread, any other type of trade, I should have a general idea knowing what my P&L diagram should look like. And then when I actually pull it up in my platform, it should kind of obviously look like what I was thinking it was going to look like. So trust me, I can't tell you how many times I caught myself where I meant to buy a call and maybe I sold a call instead, and I'm like, oh, that's not what the P&L diagram looked like or should look like, and I would catch myself with a mistake. So like I said, if you're like, you know what, I'm just going to let my platform draw it for me, that's fine. But as a little suggestion there, I definitely tell you at least have an idea what they should look like, because trust me, it's helped me more than a few times catching a bad entry here. So here's kind of a P&L diagram drawn out on a call credit spread. Again, if the stock finishes at or below the short strike, you're at max profit at expiration. Your break even is adding the credit to the short strike, and of course the most you can lose if the underlying is trading at or above the long strike at expiration. Pretty simple here. All right, let's talk about the Greeks here. Let's talk about option delta here. So the actual definition of delta is the rate of change of an options position value relative to the stock. So keeping it simple, for every dollar the underlying moves, based on the delta, that's how much the premium should change, right? Whether it's a call option or a spread. And we'll take a look at deltas on the spread as well. So for every dollar the underlying moves, the delta will tell you how much the premium should change. Now, a trader's definition, or quote unquote a trader's definition, is delta. They use it as the likelihood of an option expiring in the money. So looking at an option chain here, and we can see delta kind of in the middle here. The 60 strike calls here, they have a delta about 83.5. So certainly it can't control, of course, what the market is doing or outside influence, but based on the current price, based on the implied volatility of the options, it says that that option, the 60 strike call, has about an 83.5% chance of expiring in the money. Now if we take an opposite extreme, move down to the 85 strike calls, they have a delta of about 31. So based on that criteria, it's saying it's got about a 31% chance or a 69% chance that that option, based on the current price and volatility levels, that's going to expire out of the money. Now, a lot of option traders use this as kind of a gauge. They look for, putting the odds on their side, saying that if it has a low delta, if you're selling premium, well, the odds are on my side. And they're, again, high probability trading. We'll take a look at that in a second here. Now, advantages of vertical credit spreads, bull puts, bear call spreads, whatever you want to call them. We kind of went over this already, right? They're safer than naked options. We have unlimited risk down to zero for selling a put, of course, and theoretically unlimited risk to infinity on selling call options here. So certainly by spreading it out, having the ability to buy call and buy put limits our potential losses here. And of course, what are we talking about? This whole little PowerPoint presentation is designed as a high probability trade. Out of the money credit spreads, which I generally do here, can be designed as high probability trades. Now, it could take advantage of high implied volatility, and as I mentioned, implied volatility in general is pretty low right now, so maybe not the best time in the world to be selling, a plethora of credit spreads with implied volatility generally being low, unless, quarterly earnings are pretty much over, but I think Cisco and Walmart are announcing. And of course, it's a volatile event, so implied volatility is going to be high for those volatile events. And time decay, right? As we said, options are decaying asset. So just even part of a spread, every day that passes, premium is going to decrease and decrease. And what I really like this, that's why it's a high probability trade, when they're set up out of the money, meaning that the underlying is trading above or below, whether it's a call credit spread or a put credit spread, it could be set up 3 out of 4 ways of profit. Again, high probability trading, 3 out of 4 ways of profit. Now, the exposure that credit spreads have is, which we kind of touched on already, is direction, right, based on delta. So it's a spread, but we're still going to have a positive or negative delta on that spread. And of course, as we mentioned already, volatility, which is we're selling premium. Again, we prefer the implied volatility to drop, and for buying premium, we prefer the implied volatility to move higher. So Vega measures volatility. So for every 1% change, Vega is going to change the premium by that, whatever Vega is at that point. So certainly, this is a couple things, again, probably a little more advanced than we're going to have time to talk about here today, but you need to consider both when attempt, and you prefer to, of course, profit from both. You prefer selling premium, have the implied volatility drop, and you prefer the underlying, of course, to move in your direction, right? So delta and both Vega can help you here. So now, as a general guideline here, I go in there, I want to know my max gain and max loss on the trade. Doesn't mean I have to realize either one of them. Certainly I usually exit a position ahead of my max gain, and usually I'm exiting a position for a loss ahead of my max loss. So we want a high probability trade, so we're going to kind of figure that out if it feels like it's high probability. So anywhere from 2 weeks to 6 weeks is a time horizon. Because we know options are a decaying asset. So usually they kind of say from 30 days in, options kind of increase the theta, the time decay increases 30 days in. But sometimes, and I'm going to show you an example that I talked about today where I could do for even less than a week. And of course, what's the pros and cons? Well, the pros and cons are, well, if I'm selling it short, I probably have to be selling closer to where the underlying is trading. But as I always say with options, there's always trade-offs. You give up something and get something in return. Well, if I'm selling short-term, my theta with just a few days to go to expiration, it's certainly going to be bigger and decaying my spread at a lot faster rate than if I if I sold a spread that's maybe a month out or so. So definitely want to check that there's no earnings or other news expected. Like I said, now certainly can you sell credit spreads over earnings announcements like Cisco and Walmart that's coming up, after the close today? You can. As a general rule of thumb, I don't do it. There's other ways that I play earnings than selling credit spreads. But certainly the draw is implied volatility is high, right, because of the volatile event coming up, the quarterly earnings here. So as a general guideline, I definitely try to avoid any earnings announcements here. So start with the direction. I'm a big support and resistance technical type of guy here. So I look for support and resistance areas that I don't believe the underlying will move above or below. Obviously above a resistance level or below a support level. And a lot of times I'm going to manage those trades off that area as well. So I'll have maybe one or two particular support or resistance levels that I might set up the trade above or below. And I also like to manage the trade off those areas as well. Now we move on to the volatility aspect of it. Now we like to see if the volatility is elevated. Particularly maybe trading above the historical volatility, saying, maybe, again, the current implied volatility is trading above historical levels. It might be a little bit elevated. It might be a time to consider selling premium. Now, I kind of want to put them in conjunction, right? Just because volatility is elevated doesn't mean I just go out and just sell credit spreads because I'm selling expensive premium. I definitely want to combo it with what I see on the chart. So usually, as a general rule of thumb, I only trade the credit spread if it is. As I said, in general, except for these last couple of days, implied volatility levels have been really, really low. So over the last several weeks, credit spreads haven't been the greatest option strategy out there. But with expected moves coming up in the market, obviously some volatility, even with the Fed minutes being released today, and expected maybe move in the market, I think a lot of people are expecting the market at least to pull in a little bit here. The implied volatility levels might start to be elevated. So it's kind of a good time to consider some of these guys here. So let's look at an old example here on Ralph Lauren RL chart. You can see it's kind of had, trading a little channel there over the last couple months. And it has kind of a resistance level, right below that 165 level. All right, based on previous price action. And not that resistance is going to hold again, trying to put the odds on my side, better chance that support and resistance will hold and break through. I say, you know what? I believe that Ralph Lauren will stay below at 165 level by expiration. So take a look at the volatility. I look at the implied volatility. The red line is the current implied volatility, that kind of, I don't know what color you call that, kind of faded bluish colored line here is the historical volatility. So at this point, the current implied volatility levels are higher than historical, saying, well, maybe the options are priced a little bit more expensive here. So what is the reward to risk on the credit? Yeah, we'll talk about that in a second here. So, all right. So now, if the high probability trade, before you go up further with this, the high probability trade, well, what does that generally mean? Well, high probability trade, odds are pretty good to make money on the trade. Well, as I say with option trading, it comes with a plus and minus here. If I have a good chance to make money, well, I'm generally going to risk more than I'm willing to make on the trade. Now, there's certainly different ways to kind of finagle this, don't get me wrong, but if you're setting up as a true high probability trade, unfortunately, you're going to have to risk more generally than you're willing to make on these trades here. So here we come in, say, all right, we're going to sell the 165 call, right? I expect the underlying to stay at 165 or below by expiration, and I'm going to buy the 170 for protection in case Ralph Lauren continues to move higher. Here I bring in a credit of 65 cents. So no matter what happens, even if Ralph Lauren tanks and drops down to $20, the most I could ever make on this trade is that 65 cents, or in real terms, $65 what I brought in. Now the risk factor is $5 difference between the bought and sold strikes, 165 and 170, minus the credit received, or 65 cents, right? Or in this case, $435 or $435 in real terms. Now, if we go back to the trader's definition, we see that we have a delta of about 20 on our short 165, right? So based on current prices, or based on the current underlying, and based on the implied volatility right now, it's saying that it's got about a, 80% chance, you gotta like those odds, right? 80% chance that that 165 call is going to expire worthless, right? So again, take it for what it's worth. A lot of option traders feel that warm, fuzzy feeling inside if they see a relatively low delta on their credit spread on the sold strike. So again, it's up to you. Based on the option pricing, based on the underlying, it's saying it's got about a 20% chance it can expire in the money, and you take the flip side, about 80% chance. So thus, why you get, you're risking 435 to make 65, because the odds are, at least on this case, overwhelmingly on your side here. Now, if we pull up a P&L diagram, again, on a call credit spread, again, the most we can make is the credit we brought in at 65 cents, and that's, again, if Ralph Lauren is trading at 165 or lower at expiration. And don't forget, I could always buy this guy back for profit or loss ahead of time as well. I don't necessarily have to lose sleep until expiration. I certainly can close it out ahead of time here. My max risk is if Ralph Lauren is trading at 170 or higher at expiration, I would lose that 435. And of course, we add the credit received at 65 cents to the short call in this case, and our break even at expiration would be 165.65. So if it's anywhere below 165.65 at expiration, I would make money on this call credit spread. So pretty simple, but pretty complicated. Lots of moving parts as well here. So, and why do we talk about volatility? Now, let's just quickly talk about this. Why do we talk about volatility here? Well, we said volatility is directly related to the option pricing. Now, again, if options are cheap, and this where I always say these are things that you learn through experience, through trading option experience. Here, you can learn these things, but when you actually go through it, go through different cycles of the market. Obviously bearish markets, bullish markets. For option traders, when implied volatility is high, when implied volatility is low, you kind of figure these things out your own. But certainly, we, as I said, barely have done any credit spreads over the last several weeks because the implied volatility levels have been extremely low, meaning option premium is cheap. And don't get me wrong, we're buying and selling, but overall, you prefer the implied volatility higher. Now, if the implied volatility continues to increase, particularly if the market decides to move lower, you'll see that you'll be able to sell and bring in a bigger credit, which obviously produces a bigger max profit potential. And at the same time, if you're bringing in a bigger credit, what's that going to do? It's going to decrease your loss potential, right? If you bring in more of a credit, well, your risk is going to go down as well. So it makes sense. So obviously, the higher the premiums are, the higher the implied volatilities, the better it is for credit spreads here. All right, so here's a couple. I just want to kind of bring these up, a couple that I talked about today. And kind of looking at FedEx. So FedEx is announcing, I think, after September monthly expiration there, and it's kind of had a nice run up. And we can see it's kind of right at a little resistance level here from previous pivot levels back in April here. So we look at this and say, all right, well, I'm counting on, doesn't mean it's going to happen, but I'm counting on that maybe FedEx will stay below kind of that resistance level at 167. Now, we're not talking about trade management here, but I would consider managing a trade if it, moved convincingly above that 167 level, right? I might even switch to a bullish trade if that was the case here. So at this point, I'm counting on resistance to hold and FedEx to stay below that resistance level. So, all right. Well, this is just for an example anyway, though. But yeah, so here I come in and say, all right, well, let's sell just above that 167 level. So with about a month to go, September monthly expiration here, I could sell a call credit spread and bring in 85 cents. So I'm selling the 170 call for $1.18, and I'm buying for protection in case I don't do anything about it, which would be poor management, but I'm buying the 175 for protection, and it's going to cost me 33 cents. The net of that result is an 85 cent or $85 credit. And again, if FedEx closed at 170 or lower by September monthly expiration, those calls expire worthless, I keep the premium. Max risk, $5 difference in the strikes, minus that credit of 85 cents or $4.15, and that would be suffered in humiliation if FedEx is trading at 175 or higher and you did nothing by September monthly expiration. Now, if we look at the delta on the trade, remember we're long and short an option on here, so it's going to be a difference between them. So we got about a 28 and a 10 delta here. So net, I have an 18 delta on this trade, and it's actually a negative 18 delta. So for every dollar the underlying moves, either higher or lower, we're either going to add or decrease the spread's premium currently by 18 cents based on that spread's delta. So in this case, it's a negative delta, and of course we sold a call spread, so we prefer FedEx to move lower. So if it did drop $1 based on that negative 18 delta, and we got a negative $1 move lower, we would decrease the spread's premium. Again, we want to sell premium, buy back for less, so in this case we would decrease the premium by 18 cents. Now, that's not the only factor working here, right? Because that could go either way for us depending on the underlying, but theta is always working. Now, it's relatively small with about a month to go here, but we can see on our short option, it's losing value about 4 cents a day versus a long protection call, about 2 cents a day. So the net is about a 2 cents theta. So for every day that passes, currently, the premium is being decreased about 2 cents due to time decay, in other words, theta on this trade. So again, a couple different ways to possibly, make money. There's obviously 3 ways, including Vega, but that'll be another 2-hour discussion talking about that. But clearly, delta and theta could be affecting the trade. Now, theta always going to help us out, decreasing the premium. Delta, not so sure. We need the underlying to cooperate with us as well here. So, all right. So let's take a look at another one here. And this is, generally as option traders, you're not going to be day traders here, but certainly it could happen. And this is an example that I talked about today here. So we're looking at Chipotle here, CMG. And we can see it's got a pretty strong from the past, pretty strong support level, or I should say potential support level, down at that 390 area. So of course, obviously it's been a long time since Chipotle has dropped to that level. So we're counting on potential support to keep the stock above that level. Now, on both these examples, implied volatility, I didn't want to put up another thing, but implied volatility was slightly higher than historical volatility at this time. So again, premium's not exactly sky high, but still slightly above historical levels here. So here, I come in and say, all right, well, obviously, I'm counting on Chipotle to stay above that 390 level. So I want to sell a put spread. So there I am. 3 out of 4 ways of making money. Because why? Well, we're selling a 390 put, right? Counting on that support area to hold. Naturally, if Chipotle stays above that level, that put option will expire worthless, right? Nobody wants to sell Chipotle for 390 when they can go in the market and sell it for more if it's trading above that level. And of course, our protection is, in this case, we do a $5 spread. We bought the 385 put. In case Chipotle tanks, drops down, we always want to have the right to sell Chipotle at a certain level there. So it kind of limits our loss on here. But 3 out of 4 ways of making money, right? With the current underlying trading around 395.50, well, I have 3 out of 4 ways of making money, right? Chipotle can move higher, right? Chipotle could trade sideways, and here, Chipotle could even drop $5 by this Friday's expiration. So this is August monthly expiration, which is this Friday's expiration, so short-term trade here. So it could even drop $5 against us and I could still make my max profit on this trade. So I believe it. Doug says he traded options CMG when it was at 55 back in 2006. I know. My first trade made $100. Well, that was your first trade on top of it too. That's pretty funny if it was. So, oh, the good old days, huh? 10 years ago. All right. So here we sell a 390 put, bringing a credit of $1.25, and buy the 3-day 5 for protection, 55 cents. Net, bring in 85 cents. 85 cents. Again, those puts expire worthless, 390 or higher. We keep the premium. Max risk, $5, difference in the bought and sold strikes, minus that 85 cents, or in this case, $4.15. Now here, we have a delta of what? $12.25. So net, it's got a 13 delta, which in this case is a positive delta, because we obviously prefer that Chipotle move higher than lower, right? Move farther away from our put strikes. So if it did move $1 higher, well, based on a delta of positive 13, well, we would decrease the spreads premium by 13 cents. Now, of course, if Chipotle dropped $1, we'd increase the premium by 13 cents, maybe making it more expensive to buy back, which of course would lead to a loss here. Now, going shorter term, obviously we looked at 30 days out. Well, here we're looking 3 days out. More expensive premium as well. Theta is going to be bigger. So here, on our short put, it's about 57 cents a day, and our long protection put, about 33 cents a day, right? So net, you got close to a quarter. So for every day that passes, that premium should decrease about a quarter, right? For every day that passes, currently based on that theta, the premium should decrease. Now, it'd be great if Chipotle just traded sideways from now until Friday's close, right? Theta would just eat away the premium on the put options, and we keep the 85 cents. Now, as I mentioned already, I don't necessarily day trade these guys, but you know, when you're going short term, you're playing with maybe sometimes a more volatile stock, which Chipotle in the past has been kind of a volatile stock. I took this screenshot, you know, less than an hour later after I took the initial one. Now we can see what happened with Chipotle. You know, it was trading, it was trading about $395.50. Now it rallied up to about $398.50, so it rallied up about $3. Now at this point, how do we get out of this position? Well, we sold the 390, could buy it back for 70 cents. We bought the 385, we could sell it for a quarter. So net, we could buy this guy back for 45 cents. So we sold it for 85 cents. Currently at the time of the screenshot, a little while ago, could buy it back for 45 cents. Now we had two things work for us there, right? We had that positive delta. Chipotle moved higher, and time decreased the premium. So we had the combination working for us. All right, takeaway, simple series of analysis, obviously a little bit more complicated than we went through today here, but again, using support and resistance levels. You can use standard deviation. I generally like using support and resistance levels, setting up where I'm going to set up my call credit spread, where I'm going to set my put credit spread. Prefer, of course, and maybe we'll get it, as the market maybe continues to be weak here. Doesn't mean it's going to drop yet. I don't have full faith it will at this point, but elevated volatility certainly helps the premium here. Again, how do the prices line up? Does it make sense? You know, it has to make sense. And of course, have a plan. I mean the management plan. Don't let, you know, to me, sometimes these guys are some of the hardest option strategies to manage because you are risking more than you're willing to make. So a lot of people get in trouble by doing that. So have a plan thought out before you put the trade on. Don't let the emotional trader make the plan here. So, all right, and I just kind of left it here. This is one of my favorite trading sayings of all time. I just wait until there's money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. In essence, by not wanting to trade, I've inadvertently transformed myself into a master of patience by forcing myself to wait until there was a trade that appeared so compelling that I could not stand the thought of not taking it. I had vastly improved the odds. James Rogers. I like that. Wait until there's money lying in the corner. Not every trade could be money lying in the corner. I definitely want to have a significant amount of them here. All right, so quickly, I talked about, and I'm not a sales guy here, I'm a trader here. I quickly talked about these trades. Well, where these trades are talked about, and that's where this is, themarkettaker.com/GC49. It's a live trading class I've done for almost 5 years, every single day in the market. It's a daily class with about 10, sometimes less, sometimes more, not just throwing out trade ideas, how to manage them, what they're about, how I came to this conclusion here. Mostly spreads, a lot of income trades. We have a lot of investors there as well. So every single day, all the classes start at 9 o'clock Central Time. In other words, 30 minutes after the market is open. I always go over an hour. I always go over an hour anyway, just because I get involved in things and people have some suggestions. They want me to look at things. All the classes are recorded. All the classes are recorded. So if you can't attend it live, but a lot of attend it live, go back and check out the recording as well. No problem. You have to review that as well. So go to markettaker.com, GC49. Generally, you know, it's $9.97 a quarter, but for a 1 month kind of trial period here, it's about $49. It's about $49. So this is certainly our busiest class we have here. Everybody wants to trade ideas, but like I said, I try to make it more as a educational event than just throwing trade ideas, breaking them down. We recover trades we talked about. We revisit them all the time, talk about the management, which to me is the most important part of trading. So go to markettaker.com, GC49 here, a bunch of little bonuses there. And let me know if you have any questions about that then. So what's a good amount to start with to trade credit spreads? Well, again, it's up to you and how many contracts you want to trade. Now, certainly the risk-reward perspective is, you know, again, they're going to hold generally how much you can lose on the trade. So if you brought in $1 credit on a $5 spread, well, your max loss is $4 or $400. So, you know, as a general rule of thumb, just depends how many contracts you're to trade and what kind of type of spread. Now, you could do some smaller spreads. They don't necessarily have to be $5, $10 spreads. You know, they could be dollar spread increments where you're not risking as much so you get your feet wet on some of these guys. So, so that's kind of a tough question to answer here. And why is that? Out of 5 trades, you profit on 4 and lose on 1, and your account is almost wiped even when you trade amount, size, and all. Yeah, well, that's, again, that gets down to the management part of it. And certainly there's unexpected moves against you, which can really wipe out, especially on a credit spread here, but that's why it's so important. I'm a big advocate of multiple exits, especially on credit spreads here. So again, that's exactly what he kind of said. You know, you'll profit on 5, 6, 7 credit spreads in a row, and that last one will wipe out your previous, you know, your previous earnings. And it's frustrating. It's frustrating. That's why I'm such an advocate for management on these trades. It's so, so important. So, all right. So please check it out. I hope you enjoy this presentation. Something I'm very, very passionate about, just like trading. And I hope you guys have a great, great day.